Okay, so if it's clear, we will kick off this meeting. So good afternoon, everyone, and welcome to the MSX discussion for OQIC, which is the second. Let me first introduce myself. My name is Hasan Al Lawati, and I'm the Chief Executive Officer of OQIC. Along with me, I have Mohamed Jawad, CFO of OQIC. I have Ali Abdul Azim, Chief Business Officer of OQIC, and I have Omar Al-Shanfari, Senior Manager, HR Admin and Government Relationship. So all four of us are present for today's meeting, and I have with me my colleagues joining online as well. So let me walk you through the agenda very quickly before we get into more detail. So, we will introduce to you the board of directors for OQIC, which is again post the merger that we had with Vision Insurance recently. A snapshot on the top management of the organization chart. Then we'll go through the financial performance of OQIC, predominantly 2022, and some highlights on the previous 2 years as well. And this will cover the top line income, underwriting income, and as well the mix of our portfolio. Then we move into the investment. How do we perform over the past year, which is 2022, and compare that with the previous years. Then we will shed some light on the recent merger with Vision Insurance Company, and then the implication of IFRS 17, which is a new accounting standard that needs to be applied for the insurance industry, and then some of the regulatory requirements. And then we will end up with a slot for questions and answers. So with regards to the board of directors of OQIC, there has been no change post-merger. So His Excellency Khalaf Al-Manna'i continues to be the chairman of the board, and which is vice chaired by Mr. Musallam Qatan. Then we have Mr. Salim Al-Manna'i, who is also heading the strategy investment and nomination committee. Then we have Mr. Ali Salih Al-Fadala, who continues to be a board member and chairs the nomination remuneration committee. Then we have Mr. Tariq Marzouk Al-Shamlan, a board member and chairman of ARC committee. Then we have Mr. Mohamed Al-Farousi, chairman of strategy investment committee, and there has been no change to these designations. And finally, we have Mr. Saeed Al-Muhannadi, who is a board member and sits into the audit committee and the remuneration committee as well. With regards to the chart, so these are the senior managers of let's say the OQIC post merger. So I have Ali Mohamed Al Lawati, who is Chief Business Officer, Commercial Lines. Mohamed Jawad, who is a CFO and the investment relation, as well as board secretary. And then we have Omar Al-Shanfari, and all of us are present today here with you, and to interact as needed. Without further ado, I'll hand over the next slides to Mohamed to walk you through the financial performance before I take back from him when it comes to the merger.
Hi, everybody. Here we have a snapshot of company performance for the past 3 years. We just wanted to make it very summarized here, then we will go into further details in next slides. With regards to company gross written premiums, GWP, we can notice that the company continued a strong momentum in terms of increasing gross written premiums. So we can see that from 2022 to 2021 to 2022, the company reached to 37.7 million from 31.4. In terms of underwriting income also witnessed a slight increase between 2022 and 2021. So we reached to 2.9 million out of 2.8 million, which is for both years 2020 and 2021. In terms of investment income, despite the challenging market and whatever happening in investment economy and areas, we approached 3.1 million in 2022 from 3 million, which is a slight increase, but we maintained our investment portfolio, a selective and strong investments which are managed well by us. In terms of profit after tax, the company profit after tax decreased slightly from 3.1 million to 2.9 million in 2022, and that is due to the increase in claim momentum across different line of businesses.
I also tax.
Yeah, we'll go to that. So as I stated earlier, we will take you through further details in this slide in terms of performance. So as I mentioned, 37.6 is the GWP 2022 from 31.3. So majorly we wrote additional business in engineering products, motor, energy, and marine and cargo. This represents a 20% increase in GWP in 2022. When we go to net underwriting income, we can see 3% increase in net underwriting income. So we reached to 2.9 million, and that is due to our philosophy in underwriting and our focus on increasing our retention in profitable lines. In terms of expenses, we can see that expenses increased by 7% from 2.14 to 2.2 million. That is mainly due to the expenses incurred in getting the merger deal and associated expenses, which already incurred in 2022. In terms of operating income, we can see that the company still maintained a positive operating income in the market. So last year we had, in 2021, the operating income was 390K. In 2022, it reduced a little bit due to higher expenses, and we reached to 340K. Going to investment income, we increased by 2% despite the challenging investment environment. So our net profit after tax is almost similar to 2022, 2% reduction. So we reached to 3.25 million compared to 3.31 million. We got a huge impact in terms of income tax expenses. So that is more than double. So we need to 380,000 compared to 170,000. That was mainly due to realization of certain equities where we predicted and studied that this equity might not perform well in 2022. So we decided to book the profits and exit from these investments. So we incurred that income tax expense on investments. That gave us a bottom line of 2.87 million compared to 3.14, which is 9% compared to last year. Moving to the mix of our GWP and underwriting income, we can see that comparing 2022 with 2021, the mix of GWP is almost similar. We increased our business in marine and in marine business. We can see that retail business also increased from 14% back in 2021 to 16% in 2022. Rest lines almost plus minus, they are similar. But when we come to underwriting income mix, we can see that life and medical, despite reducing the reduction in business in 2022 slightly by 2%. However, we made 10% operating underwriting income in life and medical. We can see as well that commercial lines are performing well in terms of underwriting income across. So we have marine 9% compared to 5% last year. We have property liability as well. The underwriting income increased from previous year.
This is the contribution to the quarter.
Yes. Yeah. So these mix already contributed to our underwriting income, which we reported in both years. Going to our investment details, the investment details between 2021 and 2022 somehow are similar. We can notice a shift from fixed income, fixed deposits toward bonds in 2022. As we witnessed a lower interest income in fixed deposit during the year 2022, we decided to not renew certain fixed deposit, and we got a good offer in terms of bonds and sukuk. So we placed around 2 to 3 million riyal more in bonds and sukuk to balance our yields, which we were getting earlier on fixed income and on fixed deposit. So this is the portfolio composition. In terms of investment income, we can see that realized and unrealized gains on equities are contributing more than 50% in 2021. And in 2022, it contributed to 50% also. And even though we shifted to bonds, but earlier fixed deposit rates were so high back in 2021 and 2020, so we balanced that by increasing our interest income from bonds. So moving to the merger, CEO will take it.
So thank you, Mohammed. So let's discuss a little bit about the recent activity in terms of the M&A space. First of all, I'm happy to announce that the merger has been successfully completed between OQIC and Vision, and that is merger by incorporation. And this was finalized or completed legally back in February 2023, where the consideration was completely paid to the shareholders of Vision Insurance. And now Vision Insurance, has been dissolved. All the assets, liabilities, business, and people have been transferred to OQIC. So a slight highlight about that. I mean, before we move into the capital side of it, you all remember that, and we have made several disclosures to the market, and EGM as well that was successfully conducted. So there were two offers for the consideration, two options for the consideration. There was a cash deal and a cash element, as well as a share swap element. Share swap element was capped at 20%, and the intention and the appetite was to go more towards the cash, and the outcome was 99.9% of shareholders of Vision opted for the option 1, which was the default option, and that's the cash option, and 0.1% opted for share swap. As a result, the paid up capital changed. So before that, we increased the authorized capital from 20 million Omani riyals to 30 million. And then the paid up capital increased from 10 million, which is the minimum requirement by the Capital Market Authority, to around 21.9 million. Excuse me, there is a mistake, the typo error. It's not 16, it is 21.9 million Omani riyals. And this is also reflected in the MSX website. So apologies for that error. The asset base also got increased, and then there's, we are seeing, great synergies across, all lines of business. In fact, across different functions of the two companies. So an update there. So all the people have been transferred through the Ministry of Labor. So that has been completed. Businesses are getting merged as well, and the seating as well of the people have been also mobilized. So we are operating from 2 different offices other than the branches. So we have this our OQIC office in Al Khuwair, which is let's call it the head office for now, and then we still have our building in Rui, where some of the departments are working from there. So until we bring everybody into one space, so we have divided department-wise in terms of the seating, and not earlier Vision and today OQIC. We are all one OQIC, so some departments have been shifted to the Rui building, and other departments have shifted or residing in this building, which is in Al Khuwair. So the ultimate goal or intention is to position OQIC among the top 3 in terms of the top line in 2023, and definitely to be on the top when it comes to bottom line, and perhaps we achieved that in 2024. Let's not forget that we have acquisition cost associated with the merger. Some of that has been realized in 2022, and hence we have seen slight increase in or 7% increase in the expenses, which is major chunk of that has come from the merger expenses. And then there is another set of merger expenses which we are realizing in 2023. And then of course there are other costs that will be associated in integrating the system. So that process has been initiated, and we have divided the IT integration in terms of systems, softwares, applications into 2 phases. phase 1 has been successfully completed, where all the policies are being issued under the name of OQIC, be it in the personal lines through branches or for the corporate or life and medical. We have been come up with a short-term setup. How do we deal with the new business versus the renewal business of both entities? So that phase has been successfully completed, and then now we are into the phase 2, which is the complete migration of data from one software to other software. So that's work in progress, and it will be completed before the end of the year. In terms of branches, so Vision X-Vision had around 24 branches across the Sultanate. OQIC had 8 branches, and then the number that you see in front of you in the slide 19, this is the non-duplicated branch. So these are the ultimate 19 branches that will be keeping across the country, and some of the duplicated branches have been already merged, and some of them are in the process of ending the contract. But that's only where 2 branches are in the same place within 2-kilometer distances. But this is the intention, that 19 branches in 19 different locations that will continue, and we will be servicing our customers from these branches. Right. So I'm handing over to Mohamed once again to shed light on the IFRS 17, and then at the very end we'll be welcoming questions from you across the presentation.
Yeah. Going to IFRS 17 and IFRS 9 implications on the industry. So as per the standards, we should start applying IFRS 17 and 9 with the effective date of 1st January 23. So when we talk about IFRS 17 and 9, we are talking about a huge change in the industry in terms of accounting for insurance and reinsurance business. So year of adoption 2023 will have an impact on across the companies for this adoption. In terms of OQIC readiness to adopt both standards, IFRS 17 insurance contracts and IFRS 9 financial instruments, we have set a team in the company who are focusing mainly on IFRS 17 and 9 and the implementation of these standards to comply with the regulation. In terms of our readiness, the company is progressing well to achieve the target, and we are nearly to the completion stage for both. In terms of our reporting for Q1 2023, which might be a question across analysts and investors, we decided to report Q1 results based on combined approach. So X-Vision results along with OQIC will be reported for Q1 2023. Going to the regulatory requirements in terms of solvency position and lien position, as per Capital Market Authority amendments and Annexure 18 of Executive Regulation, Capital Market Authority introduced the computation of solvency margin based on new risk-based solvency approach framework. So the company adopted risk-based solvency approach. Basically, risk-based solvency approach require company to have a solvency in general business of around 4 million Omani Riyal or higher based on risk-based solvency. So either you have 4 million Riyal as a RBC solvency margin or whatever comes out of your calculation. So 4 million Riyal for general business and 2 million Riyal for medical business and 1 million Riyal for life business. When we reported 2022 results, we can see that our risk-based solvency was 181% compared to the minimum requirement of 8 million. So we had 22.3 million. And this is the trend of OQIC across earlier years as well. So we are well solvent regardless of all solvency margin calculation or RBC framework. In terms of lien position, the company also leans sufficient asset to protect policyholders' fund. So in 2022, the lien position was 20.2 million Riyal lien with Capital Market Authority compared to the minimum requirement of 15.4 million. And we can see the same trend across years. We are exceeding the lien requirement by a big amount.
Okay, thank you, Mohammed. So we have reached the end of the presentation from our side, and before we get into the Q&A, so before we go, I just wanted to also, share my appreciation and support, firstly to the Capital Market Authority, where they have, really supported us and guided us throughout the merger process. That was without which we would not have successfully completed the merger. I would like also to thank my colleagues, where on one hand continuing business as usual, and on the other hand we had to work towards the merger, which was a great task at hand, and also to the clients and customers of OQIC for continuing their support and trust by trusting us with their insurances through the year 2022, and of course to all the other stakeholders for their support and trust that they have put into OQIC. So with that, we open the floor for questions and answers. So you may please raise your hand so that we can manage the process swiftly. Yes, Vishnu. Go ahead. Please.
Hello, can you hear me?
Yes, we can.
Yeah, good afternoon, gentlemen. Thank you so much for the presentation. Firstly, congratulations on the completion of the merger. My first question was, you mentioned that there are some costs associated with the entire process of the merger, which have partly been taken in Q4 of 22 and will be also taken in 2023. Could you give us a sense of what is the quantum of those costs that will flow through in 2023 G&A or in general?
Sure. So when we refer to the acquisition cost or the merger cost, we are talking about all the advisory fees that we have incurred from for the financial advisors to the legal advisors, for the due diligence process that was conducted, for the valuation process for both entities. So all of that come into as a merger cost. And then, yes, on the legal, of course, the legal cost, the legal due diligence as well. So the due diligence process was conducted heavily across, almost all operations of Vision, and it was done both sides, by the way. So Vision's due diligence on OQIC and OQIC's due diligence on Vision. So as for the IFRS, if I remember correctly, it is IFRS 3, business combination, and we have to incur the merger expenses as they realize, and there's no amortization or it can be deferred to the following year. So all of expenses that was realized in 2022 has been accounted for, and that roughly stands at around 225,000 Omani riyals that we have already incurred and realized in 2022.
Okay, and what would the amount be for 23?
So for 2023, there's a bigger chunk than the 2022, and roughly 650,000 Omani riyals, which will be realized this year in 2023.
Okay, noted. Thanks. Basically, what I wanted to sort of understand is, you finished this deal, it's completed. Now you purchased Vision at a price of 120 paisa per share. The book value is northwards of 130. So is there sort of a one-time benefit or a consolidation benefit that the combined balance sheet will accrue because of this? I just wanted to understand that.
Yeah, Vision, in terms of our purchase, yeah, we bought the company. If we consider the balance sheet of Vision, so we bought a company at a lesser than book value. So 13.7 million is the book value, and the purchase was at 12 million Omani riyal. So around 1.3 is lower than book value. On other hand, we have also accumulated losses carried forward by Vision, and now we are in talks with tax department and capital market authority on the way to treat the carry forward losses and the reserves of the company.
Understood. Okay. Okay, understood. The next again is a technical question for our understanding. The CMA law, initially required a company to have 40% flotation. I think now the free float requirement is 25% with regards to the insurance sector. Since the two top shareholders of Oman Qatar own more than 75%, would that be a hindrance? Would the company continue to remain listed? What is the path ahead? If you could just throw some light on that, please.
Yeah, in terms of, you are right, the regulations stayed the same, but when you enter into a merger by incorporation activity with another company, a transaction like this nature, so this article is waived. So the ownership can go even up to 75% by single or two shareholders. So the company will remain listed in the market with the current shareholding pattern.
Understood. Okay, thank you for that clarification. The next, it would be more of a comment/question. We saw the numbers for Vision Insurance specifically because I believe now that it's a combined entity, I would also be addressing those questions to Oman Qatar management. And we noticed that the company, after a long time and after a lot of pain, had a slight turnaround in operating performance. It in fact reported a positive operating performance, which was very pleasing to see. So that benefit is something that you would accrue going forward from day one, where they've spoken about their strategy and they've spoken about the things they put in place, etc. And now that's bearing fruit. So that's something. What would your comments be on that and the combined entity in terms of operating performance?
Yes, so in terms of the combined entity, we see a positive sign for the combined entity. We during the due diligence phase, we have got into the nitty-gritty of issues or the opportunities that lie with Vision Insurance, and we have a great clarity on the performance and what exactly contributed to impacting the performance of Vision in the previous years. And you have seen that there is a positive turn in their performance, in the legacy Vision's performance. When you compare 2022 versus 2021, so they have made a great fixing into their business. So when we look at that and we identify the issues, right? So the processes of OQIC will prevail, the underwriting philosophy of OQIC will prevail on the business, and of course wherever there are gaps, and there are a number of gaps with OQIC, which is being filled now with the processes, with the approach and strategies that was adopted by legacy Vision. So when we keep all of that into the picture, and when we also look at the performance of OQIC this year to date, which anyhow once we close the quarter we will publish that. You see that we have already started to realize the benefits, in fact, of this merged entity. Now, an element that remains to be a one-off expense, which is what we mentioned, the 650,000 Omani riyals, which is to be which will hit our bottom line, just being the merger expenses. So that is a non-recurring in nature. We are realizing that in 2023, and this will not be carried forward in 2024. So if we just keep this element on aside for a moment, because that's the the requirement, or sorry, that's the impact of the merger. We see that the trend of OQIC combined operating ratio will also continue. And I remember this question was asked to me. I was asked in the previous session that where do we see the combined operating ratio of OQIC by towards the end of the year. And I did mention that will be hovering around 95%, and which we have delivered. And of course, the combined operating ratio that we have shared or published also includes the merger acquisition. So if you remove the element of merger acquisition, it would have been less than 94%.
Understood. Thank you for that. My next question is with regards to the retention ratio. I remember that one of the comments made by the management was one way to sort of strengthen or boost the bottom line would be to maintain top line at similar levels. Now, well, we've seen a significant growth in top line, but sort of look at higher retention ratio and sort of adjusted risk to boost bottom line. What are your comments on that, and what could be a sort of target retention ratio going forward?
Yes. So if we go back, before 2022, let's say perhaps even before 2021, the strategy of OQIC was, to be a bit careful when it comes to the medical business as well as the personal lines, mainly the motor. So we took an approach of a little safe approach of focusing on P&C and marine business. And these lines of business, the level of retention is very low, and whoever focuses on these businesses, they will predominantly rely on the net commission, let's say, income, if this is managed well, but there is no retention, and this is not a sustainable model, being an insurance company. So we started the journey of focusing on the lines where we can retain and of course manage it in a way that produces profit. So we have revamped our strategy in motor, and we have seen that in 2022, and we are also increased our retention in medical as well. And these two lines will continue to be a focus for OQIC, so that we have a sustainable net premium as well as the bottom line by appropriately managing these lines. However, we are not shying away whatsoever from the P&C, so we continue to focus on that and to grow, and have some, let's call it, risk-free income, which is very much needed to manage the to balance the portfolio and not to be fully reliant on two lines of businesses where retention is high and it is a bit risky as well given the market condition. So focus on the retention line, manage it well, and as well as get some, let's call it, risk-free income, if you will, from the other lines of businesses. So that is some sort of it. But also, if you delve deeper into the 2022, you will see that we have also the UPR charge was high. If I remember correctly, around 1.4 or 1.5 million Omani riyals was the UPR hit that we have taken, 1.53 million, and that is nothing but the growth that we have seen in our net premium. So even in 2023, we have started the year very, very well. In fact, with a great growth in our net premium. So let's not focus on the GWP at the moment. Let's talk about the net premium, and this will be the language of IFRS 17 once this is implemented. GWP doesn't mean a lot, to be honest. It's all about the net premium and then the earned premium and how you make profits out of that. So the net premium has grown significantly, and that reflects the growth in GWP as well. And with that, immediately we will be, seeing or facing, a UPR charge, which is very much fine. So we will be earning that throughout the year, throughout the policy period, and we are looking at 3 years. Our strategy was 3 years kind of driven. So we see it in the next 3 years. So we're not a short-term player. So let's take the UPR charge now, build the business, build the UPR, build the reserving and the claims as well, and then see the benefit of that as we progress in 2024 and beyond.
Noted. Point well made. And I think you hit the nail on the head when you said, anyone can grow gross premiums. It's not that difficult, but effectively it has to flow through to the bottom line. So I appreciate that point. With regards to the motor segment, what's your outlook on that particular segment? Because we've seen sort of, a COVID era currently because of shortages of chips, etc., where there have been, a big slump in car sales that's coming back on slowly. But in general, sort of the trend, at least over the last couple of years, was shifted towards second-hand cars and sort of not brand new cars, due to which there was a compression in sort of the premiums, I would imagine. So what are your thoughts and overview on that segment specifically?
So if we go back, sorry, Ali, if you want to interrupt, anytime, please do so. Right? Okay, so I'll just come to this point and then you can take over. If we go back prior to 2018, and then let's go to the date of 2015 and below, the focus was, or the market was more into comprehensive, and the main driver for the growth in the comprehensive segment was the brand new cars from the dealers, right? And then we saw there was a shift in the market, which was peaked during the COVID-19, and then during that period, most of the policies have been converted to a third party, and less of brand new vehicles. In fact, if I remember, one of the news article I read, there was a drop of 30% perhaps in the selling of the new car, and that was a great deal. And of course, selling of new car has a number of reasons. One is the the chips issue from China, for the logistics, transportation, but at the same time, it's the purchasing power and the shift in the focus of the consumer in Oman. And then not only moving into the used car, but also moving into non-GCC, so imported cars from outside GCC, and that comes at a lower value or sum insured, if you will, versus what you see in the GCC or in the Omani market. And many of the insurance companies had that view of less appetite for offering comprehensive insurance for the imported cars, and for the obvious reason that we don't have to state. But this also has changed now. So a number of insurance companies, including OQIC, we have come up with a solution for the to offer comprehensive insurance for the imported cars, albeit slightly higher than the standard rate of this was GCC. And earlier the cost of repair was very high, the duration of repair was very high because the lack of spare parts. But now, because again, our internal statistics say that around 40% of the vehicles in the Omani market are imported. And imported means could be also imported from GCC and not necessarily outside GCC. So now there's a volume in this market, and garages, workshops, have built an experience, and they can avail for the spare parts. But also we have seen a shift in to the Chinese models as well, and that was an experience where we were not very sure whether we want to get into that space back then. And now again, it's very common, and we have built, and the industry has built experience in there. Now, do I see again a trend that we go back to the comprehensive insurance very soon? Less likely in 2023. Not sure about the midterm in terms of the future, but then less likely that we see that in 2023. And a third party, overall, again, it depends. If you have a couple of or a number of large court cases related to injuries, then that makes the third party portfolio into a loss and not sustainable because the average premium is very low. But again, if a company was lucky of not incurring much of these cases, then it could be profitable. But the challenge would be on these severe cases. And of course, these severe cases, most of us are protected, against by buying the right reinsurance programs, be it treaty or on the surplus side of it. Again, you want to add something?
Yeah, I just wanted to add that the imported cars have changed the dynamics of the market, and OQIC has very carefully looked into the used cars and the imported cars, and we have been very actively underwriting those vehicles. So we are one of those companies who's taken the lead in really going into the details of what comes in, check the quality of the imported vehicles, and then offer insurances based on that. So we have been very active. Another area where OQIC has been a leading company is into the digitalization. So all the aggregator, we have maybe one very active aggregator, and OQIC has a very good relationship with that aggregator, and we are started seeing an interesting result from the electronic sellings market. So this is something that we are looking at very carefully. Electrical vehicles is something that is also emerging, and there is more demand. We again are internally looking at this, and we are forming our strategy in terms of how we are going to underwrite, how we are going to set claims. So the motor retail is a dynamic portfolio, And we are trying to keep up with the dynamics and come up with the correct strategies. Thank you.
Noted. Thank you. One last question before I let my peers take over is on your dividend policy. Compared to the profits that the company generated, if you could just give us some guidance as to how that would shape up in the next couple of years or going forward. Thank you.
So you said dividend policy, didn't you?
Yes, correct.
Dividend policy, right? Okay. So again, the board's recommendation for this period of paying out dividend, is being put forward to the shareholders in the AGM, subject to their approval. And you have seen that, sure, that this is a concern that you're highlighted now. Around four paisas per share versus 7 paisas in the previous year. And but again, let me just clarify here. So this 4 paisa is on the new capital, new number of shares that issued under new capital. If you go into the absolute terms of in terms of the Omani riyals, it is almost the same. Last year we distributed 700,000 Omani riyals, and this year it is 640,000 Omani riyals. And again, that's a slight reduction, drop in our profit, and that replaced that. So the 4%, again, this was a not a so easy discussion with the board to come up with that proposal for the AGM. Now we are looking at the year end of 2022, where this was with the 10 million Omani riyal and the 100 million Omani riyal shares, right? So that was the situation back then, and this performance is to that period. And then early 2023, in February precisely 17, the merger process got completed, and then through a private placement, the number of shares and the paid up share capital went up. So this has diluted, the minorities to some extent there, but as an expense or as a payout from the company, it's almost the same. Now, once we go into the following years, where the complete impact of merger has been realized, right? Then the idea, as long as we continue growing our bottom line, is to go to a similar year of 2022. I mean, the last period dividend, and depends on the growth. See how we process. But then the philosophy is to also reward shareholders, and give them a return on the income. And the last two, the merger or the M&A decisions is not formed in a day or two. So this was something that on our minds, on the company's mind for some time, and that's why we were focusing on the retained earnings and invest back into the business so that we get into such deals. And now that has been completed. I know we look into the performance and then reward the shareholders as well. So that what was discussed within the board in terms of the major shareholder.
All right, thank you so much, gentlemen. Just a parting comment. I think the company is fantastically managed. You've done well for shareholders. You're one of the few companies that has been able to sort of maximize its investment book. So congratulations on that, and wish the community all the best going forward. Thank you. Thank you, Vishen, indeed.
Thank you.
Anybody else? If you can, Vishen, kindly lower your hand, and happy to receive further questions.
Any other question, or are we in the session now?
So an hour is almost completed, but then any further questions? No? Okay, so with that, we announced the end of this discussion with you. Thank you very much. We really enjoyed, and thank you, Vishen, indeed, for making it very interactive. And we look forward to meeting all of you in the next session 6 months down the line. And hopefully we have a great story to.
Our AGM as well.
And our AGM, of course, yes. And hopefully, we deliver on our commitments, and we have a story to share with you in the next session. Thank you very much.
Thank you.